Hey folks, welcome to Weekend Technical Analysis Update by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. This Weekend Technical Analysis Update is for Monday, May 11th through Friday, May 15th, 2009. Well, just to summarize last week, all you can say is wow. The market really rippled both ways, but more so to the upside as the Nasdaq had its ninth straight up week in a row. The Dow and S&P closing higher for 8 weeks out of 9 weeks with a down week last week. But nonetheless, the markets are very, very impressive. The volume remains suspiciously light in recent trading weeks, which again means a little bit of caution needs to be observed in the coming weeks, regardless of whether or not the market continues higher or not. Now, the real key is this, folks. What bothers me, a couple things. Number one, this run in the markets has been the biggest run since really the Great Depression in a short amount of time. There was a key run of about 40 to 50% during the Great Depression before the market went back to all-time lows. Now, that just has to be kept in mind. Definitely doesn't mean it's going to necessarily happen this time, but I think it's important to realize that. The other thing that bothers me a little bit about historical pricing of the markets is that the Nasdaq has had, the last time the Nasdaq had 9 straight up weeks was 1999, and of course we know what happened there. The tech bubble burst and the markets came crashing down. So I think it's very ominous that we necessarily have moved up this quickly in such recent times. Now, that does not mean that the markets are going to turn around here, and I want to stress that. It doesn't necessarily mean that. The markets have shown incredible resiliency off of the Federal Reserve continuing to keep the markets on tap with good news along with the government, Obama's administration, and the Treasury Secretary Geithner. Now, that's really the key, folks, that I think is important, is that the genius of the government, Geithner, and the Federal Reserve and Bernanke in releasing little tidbits of news to keep the market running. Remember, every time you get a little bit of more good news, the market's able to gather more steam. Now, today, or last Friday, we had the unemployment number, and we also had the stress test release. Now, those were key numbers, guys. You have to understand that was the final good news for the banks. The banks got their final good push there with the stress test results. We've been waiting on those for literally months at this point and being promised to them. Now, what you're looking at is the spider's chart here on an intraday basis. But again, just to recognize really what you're talking about in this situation is that the market is going to need continual good news. It's like a heroin addict or a drug addict needing more and more good news to inject themselves with in this situation to keep the good things flowing. And I think the administration and Geithner and Bernanke all understand that, and I think that's very important because they're going to have to continue. And the question is, when that stops, what happens? And that's what I'm a little fearful of. All right, I think they have more up their sleeve. In general, they do. But the question is, when it stops, where does the market go? Does it start to collapse fast? Does it just pull back and then race to new highs? How does this come all together? Because the unemployment rate today was 8.9%. All right, going into next week, you have to pay attention to that. Now, what was negative about that, though, and you have to realize this also, is that the revisions for the previous months were pretty ugly. So again, do we actually need to trust this number, 8.9% and 500,000 and change jobs lost? Or does this mean that next month when we find out that this one's going to be revised down to 600,000? I think that's something that the market needs to figure out. Right now, the market is on an adrenaline rush, and I mean that in the most serious way. This market has continued to rebound higher and just rocket higher with all hands on deck. And you can see it by a perfect example from Friday's action. Look at the market gapping higher after those stress test numbers. Then it had a very, very hard sell-off, but it only came down right to the 50 moving average here before continuing to squeeze up. Now, what bothered me about Friday's action, guys, is the volume. Notice where the market starts to rally was a key time frame. And notice, remember, what we focus on here is price, pattern, and time. So you have to understand, when we're seeing the market pull back here into 1030, we're getting ready for a possibility of an up move. And it so happened to coincide at 1030, the key time frame, 10 and 1030, 3 and 330, key time frames. In addition, what you need to understand is look at the volume dry up right down here the whole way over until you get that sell-off around 3 o'clock at the highs double top on the market. So again, you get a nice move up off the 20 and 50 moving average here. You got the 50 touch, and then the market never even touches or breaks the 20 moving average, really touches over here for the first time late on Friday. Now, the other key was the double top, and you got to understand the key of double top. Going back to the gap up on Thursday, you have that beautiful double top, which will work as resistance come Monday if we were to gap up just ever so slightly on Monday morning. Now, that's a big up in the air because the question is, does the market gap higher? Does the market start to sell off a little and profits be taken? Remember, next week is option options expiration. Can't stress that enough, guys. Options expiration is next week. You have to be aware of that because it's going to be a big, big deal for this market. All right, the market has really raced higher. The question is how many puts to how many calls. Is the big money ready to slam the markets to take some of those calls out of play in the markets as the put-call ratio has been hovering under 1? Now, the put-call ratio has not been a good indicator of late about where the market will go. It worked like a charm going back to, about ever since 2 months ago, and before that, it worked beautifully. But since 2 months has passed, it really has not been a good indicator. And again, those of us that have followed that have had to understand that and be kind of a chameleon and shift our forces to look at other indicators. And it's really been a good thing. The fastest people to switch that will be the ones first on board for profits. That's always the way it works. When that starts to work again, it's going to be key. Now, again, notice again the sell-off and then the rally on light volume. You have a 3 o'clock sell-off coinciding with a time frame. Also, notice the double top and the trend line. See this trend line coercing right through this upper point here. Notice how it hits here, here, and goes all the way back through the high here, and this pivot point right here on the charts. That's a beautiful little diagram of what to look for. So not only do you get the double top from this point all the way back to here, but you get a cross of this trend line and a touch there for a sell-off right at the key time frame. Notice how we're putting time, price, and pattern together in this situation, and what happens, the sell-off. So those in the chat room with us, obviously getting that short call, beautiful little dump here on the markets all the way down to the 20, where we talked about having to take profits. Why? Because every time this week, from basically 3:45, 3:40 to 4 o'clock, when the markets closed, the markets have squeezed up, whether it's short covering or our buy programs hitting the market in light volume. It doesn't necessarily matter. It's still forcing the markets up. You have to be understanding of that. You always have to look for these consistencies in the market so you're prepared. Every day this week, you can see right here, buy program. Go back to right here, buy program, last 2 candles of the day, and these are 10-minute candles. All right, right here, last really hour of the day, a buy program. Going back even further, major buy program last Monday. So every day this past week, you've had these buy programs. Now, the levels I want you to watch, guys, for this market are as follows. All right, tomorrow, or make that Monday, actually, I want you to start watching this upper 93 range, 93.25. If you get through that on the 60-minute chart, I'm going to show you in a minute. I'm going to show you the next level you're going to watch for next week. On the downside, you're really going to watch a break of the 20. If that breaks, you're going to have a minor level right here. All right, at 92.35, another minor level right here, all right, and that level is right around 92.20, and then ultimately a little bit of a level right down here below the 50 moving average. You first watch the 50 moving average at 92, then at 91.80, then at 91.50. All right, those are your levels. On the upside, I want to course, or at least talk a little bit about how the levels on the upside will be. And notice how, again, 93 to 93.25 will be key. But now I want to switch to the 60-minute chart. All right, on the 60-minute, these are your levels. Notice the channel we've been in for so long. This channel, if it breaks, we're in for a hard sell-off. But if you do fall next week and touch the lower end of this channel, you will be in for a very sizable bounce. Notice how it hits here. Notice how you come through it right here, here, all the way down through here and back. This is a very lower good support line. Really just underneath it, you have the 50 moving average on the 60-minute. All right, now again, if you continue up, the 93, 93.25 will be key. But to find the next level, you have to go all the way back to early January, and this is your next level. Then after 93.25 right here, your next level would be about 94.50 on the charts on the SPY, which would be your ultimate resistance point up there. On the downside, as I mentioned, you have the 20 moving average and then the blue line, and then underneath that, the 50 moving average. Okay, having said that, folks, let's talk a little psychology. The market continues to get people more and more bullish. Just watch the media for that. The question is, does that play out, or do we still have another week or two of a run in this market? To find out for sure, what you need to do is join the Research Center, which our premium subscribers have access to, where we do 30-minute videos to plus even longer videos on technicals every night of the market week, diagnostic on the market, on oil, on the dollar, on gold, also the daily market report, pro trader watch list, technical tactic, hidden gem. By the way, the hidden gem, we had put out 2 calls at the beginning of May. In less than 1 week, each one went over 100% to the upside, from the lows to the highs, from our call to the highs, where they hit in over 100% just in that short amount of time. So just alone right there, talk about paying for a $50 service in 1 month about 100 times over between those 2 calls in the Research Center. In any case, folks, we hope you join the Research Center. It's fantastic. Also, check out the chat room. You can check out past videos. We have a history archive after 2 weeks of videos on the website and daily market reports, so you can see what you're looking at. And we hope you have a wonderful weekend and have a safe week next week trading. Be ready for craziness. Take care.